Eric Robertsen is with us now. He is the global head of research at Standard Chartered Bank, joining us from Dubai. Thank you very much for joining us early this morning, your side, Eric. If we can talk about what we're seeing in the markets, because we continue to discuss and debate about the Fed rate hikes. We got Lael Brainard expecting that rates will rise in March to combat inflation. The Asian markets following on from a negative lead on Wall Street. The Japan markets have been underperforming now for 2 sessions. The BOK also making its mark on the markets. How are you assessing what's happening? How the Asian markets are assessing all of this hawkish talk?
Hi, good morning, Emily. I think you raise an important point in referencing Asia. I think what equity markets specifically are responding to is the fact that it's not just the Federal Reserve that's going to be raising rates this year. We've seen the Bank of Korea raise rates today, and it is our expectation that certainly in the first half of the year, we're going to see a synchronized monetary tightening cycle. And so while a lot of the focus is on the Federal Reserve, and we think that's correct, we do expect them to raise rates in March. I think what markets are coming to terms with is that we'll have a number of central banks in both developed and emerging markets tightening monetary policy.
Having said that, though, there is going to be the loner, and that is the Chinese markets. The PBOC working with its own set of circumstances. How do you expect the Chinese markets to play out?
Well, this is something we've been talking quite a bit about over the last couple of weeks. China's economy is at a very different point in the business cycle and the economic cycle. We obviously saw a deceleration in growth onshore late last year, and it's our expectation that both the fiscal impulse and the credit impulse will start to turn a little bit more positive and a bit more supportive this year. So I think we have an expectation that the currency will stay extremely stable. We continue to see very good demand both from foreign investors and from onshore investors for China's government bonds. And then the question mark, and you alluded to this earlier, is how do China's equity markets perform after a difficult year last year? Our expectation is for better performance. So I think you're right to highlight that China's policy direction will be a lot more supportive than what we're seeing in the rest of the world.
Eric, we were joining in here. I was talking to someone over at Credit Suisse a couple of weeks ago, and he was suggesting that before the Fed starts hiking rates, that's the time to be buying into EM markets. Now, I saw your research as well, and you've done the analysis over the course of the last 3 rate hike cycles. Where do you see the opportunities?
Well, one of the things that I think is not getting enough attention, guys, is the fact that as we've come into this year, look, we know there are a lot of challenges remaining. Supply chains remain difficult. Inflation narrative is challenging, and we have central banks in many countries around the world tightening policy. Now, historically, that might set a very negative tone for emerging markets, but we've argued that there's a lot of negativity built in to EM asset prices. If you look at equities, for example, MSCI EM trades at nearly a 45% valuation discount to the S&P. So it's our opinion that there are very good opportunities to start looking to accumulate EM assets. I think as we get close to that first expected rate hike in March, some of those valuations will start to look really appealing for global investors.
Are you concerned with the impact of all of this FOMC monetary policy in terms of the flattening of the yield curve?
Concerned, no, but the flattening of the yield curve has been something that we have been talking quite a bit about for the last 6 months. It's been a key part of our U.S. rates forecast and remains a forecast of ours for 2022. It is our view that the Fed will front load some rate hikes in the first half of the year. But through all of that, we do expect long-term interest rates to remain extremely stable, especially as we get into the middle of 2022 and in the back half of the year. So we do expect the curve to continue to flatten. Now, if you were to see a severe flattening from here or even a curve inversion, I think the market would start to ask questions about too much tightening. But I don't think we're quite at the point where we need to have that discussion yet.
We're at the start of the bank earnings season over in the United States, and where do you see the health of our corporates?
Well, one of the things that's been amazing, Emily, is through the crisis, and partially because of central bank support and partially because of the quick rebound in credit markets, we've seen corporates able to raise a significant amount of debt through 2020 and 2021. Now, what that's done is it's shored up their balance sheets in a fairly significant way. And obviously, equity prices and the cost of equity finance remain, relatively attractive. So from a corporate balance sheet point of view and a corporate earnings point of view in the U.S., I think the corporate narrative remains extremely constructive. But again, I think this point about the ability to raise debt financing over the last 18 to 24 months, I think is going to remain a very important part of support for the corporate outlook.
Eric, really quickly, there are some that are suggesting that there is going to be quite significant inflation stickiness moving through into 2022, and that would lead to a more aggressive Fed and thus the prospect that we could see a recessionary situation. What kind of a probability would you attach to that?
I wouldn't put a high probability on it. I think the way we have framed this discussion, Will, is to say that, certainly for the first half of this year, the market's focus will be on upside inflation risks. We think the market is now getting to a point where it may be overstating those risks. We're seeing some evidence, PPI in China, where inflation is starting to come off the boil a little bit, and that's encouraging. On the other side of the discussion, I think it's premature to talk about recession. I do think the market will worry a little bit more about downside growth risks in the second half of the year. But again, to make the big leap all the way to a recession at this point in time, I think is wildly premature.
Eric, thanks for stopping by and having the conversation with us. Eric Robertsen from Standard Chartered Bank.